All right. Oops, that didn't work. So I guess we'll start off just having an informal conversation just to get everybody feeling comfortable. And then we'll launch into, more important stuff.
That sounds great. That's perfect.
Happy New Year.
Happy New Year to you. I can't believe it was almost 70 degrees yesterday.
Was that ridiculous? I mean, and then back to reality this morning, smack.
I know, it's snowing up here. I don't know if it is down by you, but.
No, well, this morning it was 37, but it was, when I looked at my phone, it said 37, but feels like 29, which is never a good thing.
No.
And then it was kind of like rainy, slow, sleety sort of thing at the when I walked this morning. Not really very nice, especially after yesterday.
No, I know. It's killer.
It's going to be a hard fall after like coming off of 70 degrees. Smash.
That is right.
So I guess explain to people who aren't familiar with your line of work, like explain what exactly, how your type of accounting, well, just tell us about your background. Tell me about your background.
Sure. I started back in 94 doing expense reduction consulting for business owners, trying to help them reduce expenses across a wide array of areas that they spend money on. Over time, that evolved and I added different tools to that toolbox of expense reduction. And in 99, came across what is called cost segregation. And as time progressed with my business in the economy, I began to really focus on cost segregation. About 2002 or so, cost segregation really took off, and in terms of acceptance within the real estate marketplace. So since 99, we've probably done 18,000 cost segregation studies across the country. We do them for almost every type of property out there, whether it's retail or office buildings or manufacturing facilities or restaurants. Anything out there that has a depreciable life is eligible to take advantage of this thing called cost segregation. And that's what we've been doing. And it's really been a great tool to help real estate folks accelerate their ability to buy property and or improve property. So that's what we've been doing.
So how, for somebody who's not familiar with, maybe somebody who's just getting into real estate investing, or somebody who hasn't ever taken advantage of, the segregated sort of accounting, could you give a scenario of how it could work? So I'm a new investor and I just bought something.
Sure. So the way that it works is if you buy a building or build a building or just do improvements, in other words, you're just a tenant. So if you buy, build, or improve a building, the IRS will automatically assume you're going to do 39-year straight line depreciation. So everything under the sun, every kind of building out there has 39-year depreciation, except for apartment buildings, which are 27 and a half. So if it's an apartment building, 27 and a half, everything else is 39. So whatever you spend on the building, let's say it was $1 million, you're going to get a write-off of that every year for the next 39 years, equal payments. So the bottom line is, I think that would be about it would end up allowing you to write it off over that amount of time. What we do is allow the client to take write-offs instead of the straight line 25 grand a year for the next 39 years. You would end up being able to find the pieces of the building that the IRS will allow you to write off over 5 years, 7 years, and 15 years. So instead of that really long depreciation, you would end up being able to take pieces of it more quickly, and thereby allowing yourself a better tax benefit early versus 39 years from now. The reallocation that we usually find on these buildings is somewhere between 20 and 30%. So
Wow.
if you spent $1 million on it, we might be able to move somewhere between 200 and 300,000 into the faster life.
Wow.
So that would end up, if it was a $300,000 reallocation and you're in the upper tax brackets, that would save you about $100,000 of income tax ish. So that can be substantial. That's on $1 million property. That's about 10% of your purchase price
It's huge.
as a tax impact first year.
Yeah. So for example, you might say, oh, well, this heating system is going to be, right. You're taking pieces of the building like that.
Like that, except, and I'll be real specific because the folks that I hang out with are usually accountants and they're real specific. And so I've got to be real careful with the way things are explained. So a building, to be a building, has to have certain elements. It has to have walls, windows, doors, roof, HVAC for comfort, electrical for lighting, and plumbing for a bathroom. And other than that, it's not considered structural or not considered a building.
Okay.
So what we do is go in and identify the wiring that isn't for lighting, or the wiring that's for secondary lighting. So a building only needs to have one source of light, or a room only needs to have one source of light. But many times, think of an office space, there might be multiple sources of light. You may have recessed light, you may have box lighting, you may have indirect light, track lights, sconces, all of these other styles of lighting other than the main lights. Well,
Mm-hmm.
all those other chandeliers, for instance, all of those other lighting products and the wiring back to the circuit breaker becomes secondary or decorative, and you can take them in a faster life. And then you've got wood trim and built-in cabinetry, and you've got the reception desk that might be, a built-in type thing. You would have kitchen cabinetry in the employee break room, let's say, and the plumbing for the employee, sinks and dishwashers in the break room.
Right. Okay.
All of these items add up. And again, they typically come to between 20 and 30% of the building purchase price.
Okay.
Once you sub out land, I needed to throw that in there. You've got to sub out land, but once you're to the building land allocation, the building number would be 20 to 30% usually. Yeah.
Okay. Wow. So then what happens when you get, so say you are able to depreciate the lighting, the decorative lighting on a 5-year schedule, what happens at the end of those 5 years? Right? Have you now lost a lot of your depreciation, or you sell the building, or you can say, oh, we're replacing the lighting? What kind of things are your options at that point?
Well, keeping in mind it's a commercial property and it's there, to typically create rental income, usually people will be maintaining and improving those buildings over time.
Yeah.
So what ends up happening is in a few years, the wear and tear on the carpet, or the lighting looks dated now, or things need to be refurbished. So bottom line is, the landlord or the owner of the property would end up changing things around and doing it, fixing it up again.
Yeah.
At that point, the depreciation clock is going to reset on that improvement. But keep in mind, I'm only talking about reallocating 20 to 30%. So that means you still always have, for the next 39 years, you still have 70 to 80% of the depreciation you would have had without me. Right. So by taking it early, it's not, some people do get nervous, or they've been told by their accountant, well, you're not going to have any depreciation later if you do this cost segregation thing. And that's not the case. You still have 70 to 80% of what you would have had, right. But the impact is so great by accelerating even the 20 or 30%, it has such a financial impact that many of our clients use this. We're the second folks in the door. So they close on the building on Monday. Tuesday morning, we're in that building doing the cost seg, because they want to have this tax deferral in their pocket right away.
Yeah.
The other upside of it is because we identify not only the 5 and the 7 and the 15-year items, but we put values on the 39-year items. And you say, why do you need that? Well, the upside of the 39-year items and having a value put on the roof or the windows or the HVAC, the upside of having those values is that when you do a renovation, so let's say 5 years in, the client goes to put a new roof on the building because the tenants are complaining it's leaking. The landlord, the owner, has tried to fix it and patch it as best possible, but it's just not working.
Yeah.
So all of a sudden, they go put a new roof on. Well, if they don't know what the old roof is valued at related to the price they paid for the building, the problem is they're going to be writing off 2 roofs, the one they just put on as the replacement roof, and then the one that came with the building. One of the things that distinguishes our cost seg reports is that we provide the detail for the original roof. Even though it's not an accelerated item, if you have that information in hand as the building owner, you can take a write-off when you replace the old roof with the new. You get to write off the old roof even though the new one just went on the depreciation schedule.
Right. So basically you're almost like fully depreciating the old roof, getting that off, and then you've got a new one that starts on its own schedule.
You got it. That's exactly right. Because it starts from that point and you would write it off for the next 39 years there. Keeping in mind that would also apply to HVAC and elevators and siding and windows and all of the other pieces that make up that 39-year element are going to be, our report is going to be reusable whenever you go and do those renovations.
Yeah, because realistically, that HVAC system is not going to probably last 40 years,
You're right. And that is the challenge, is that typically real estate investors think logically, and they think, well, the HVAC should be a 15-year item at best, and the roof won't last 39 years. And they're accurate statements on both. Yeah. But unfortunately, the way that the tax code is, it's not that way. The IRS says those are 39-year items, and those are going to be written off over 39 years, whether you can use them for that long or not.
Yeah. Okay. Interesting. So based on, I'm sort of thinking of a cost benefit analysis for an investor who is a smaller time investor. Maybe they're just buying although you can't even get a small apartment building for that little money anymore. But, let's say I have a friend who just bought a place in New Hampshire. It's a 5-unit building and it costs like $400,000. Would it make sense for him to do this type of thing? Or is there sort of a minimum purchase price where the cost of the study makes sense?
Well, back when I first started doing these back in 99, up until about 2017, we would have said the starting point would be about $1 million of purchase price. And the reason for that statement is we usually find that clients consider cost segregation a good thing to do if they get a 5-to-1 ratio. So if they spend $1 on the study, do they get back 5 or more in tax deferral? And if they hit that ratio, you give me $1, I give you 5 in tax benefit. Typically, people will move ahead, and they consider that a good scenario. We used to hit that at around $1 million. Now we hit it probably at about $500,000 because the new tax law allows what's called TCJA, or Tax Cuts and Jobs Act. That was the 2017, 2018 tax law change. Instead of making you, because I've talked about 5 and 7 and 15-year items. And so in talking about those, that would mean instead of 39-year, you're writing it off over 5 or 7 or 15 years. TCJA changed that and asked, hey, Christine, why would you want to wait 5 or 7 or 15 years? Why wouldn't you want to take it all in the first year? So you get to, if you want to, take it all in the first year. You can take that entire 5, 7, and 15-year stack of items as a write-off the very first year of purchase. That said, the normal number would, at this point, be about 500 is what our normal statement would be. If a client has, sometimes they'll have multiple properties, and then we can kind of gang them together and come up to get to that ratio that will be beneficial for them and make sense for them to do. Mm-hmm. So at 400K, we're in the right ballpark. That was probably not their first time at the rodeo. So they probably have other buildings too that we could try and make a bigger snowball for them and make it work for them that way.
But it seems like you'd be doing double the work if you did 2 different buildings.
Oh yeah.
So it wouldn't necessarily be half as expensive, right? It'd be, I'm assuming, would be twice as much
it would
to do
be
2 buildings.
Oh, without a doubt, it would be a multiple, but the tax benefit is still strong.
Yeah.
And maybe so. Usually, like I say, if we're at 500 grand, we're going to get that 5-to-1 ratio. If we get to 700 or 800 grand, maybe it's going to be 8 or 9 or 10-to-1. Yeah. So as you start to go up from the 500 grand, the benefit goes up very nicely. Yeah. If you're at a couple million, you might be looking at 10 or 15-to-1. And it continues to go up from there. So we always offer a free, no cost, no obligation estimate of tax benefit for the client, so that they know ahead of time what to expect in tax benefit, number one, and number two, what their expense would be, what their fee would be. So we work on a fixed fee basis. So if you gave me some details about your client in New Hampshire, and you said, I think it was it a 5-unit?
5 units, yeah.
5 units. And they paid about 400 grand for it. We could run an estimate of tax benefit for them. And especially that's even more accurate if you could give us the street address, because then we can Google Earth the building and see what it's like before we actually send someone out. Yeah. So because we have to send somebody out to comply with the IRS requirements for doing cost seg. Yeah. So we would give you an estimate of tax benefit. You would see it and go, hey, that looks good, or hey, doesn't work for me. Yeah. And you get to make the decision, or the client does.
Yeah. Yeah. Okay. And is there, since you do have to send somebody out, is there a sort of a circle, a range of where you'll go for this?
We have people all over the country. So we go all over the country. So we've done work. I think last year we did work in 42 different states. So Great. we have a team always, going someplace. Tomorrow I'll be up in Bangor, Maine, and we'll be doing site visits in Scarborough and some other place farther north.
Wow.
Than Bangor. So
you got to switch that around. So you're doing those kind of trips in the summer.
I know. You go when the clients call, though, right?
Yeah, exactly.
You can't always pick.
Property now for. It's too cold.
It was funny. One client of ours bought a property in Hawaii, and one of the guys had to go out in the winter and do the work in Hawaii, and he was totally psyched.
I bet. We'll give you a little discount on this one.
Exactly. Yeah.
Yeah, it works from your perspective too if you get to go someplace fun.
Yeah, exactly. That's very cool.
Yeah. And do you find? I mean, I know I had bought a property a while back, and my CPA had said, "Is there anything that you're going to replace anytime soon?" And I said, "Well, I had." Basically the day I bought it, the heating system broke, and then I knew I was going to redo the kitchen and the deck and stuff like that. So he, separated those out as different items. And that was the first time I had heard of that. I had never had anybody mention that to me. I've mentioned, our conversation to other folks since then. And a lot of investors have never heard of the kind of accounting that you're doing. Do you find that people are like, what are you talking about? That's cool.
It's very cool. Where it's particularly heavily utilized is when accountants have clients and the CPAs identify their CPA practice as real estate heavy.
Yeah.
In other words, we do a lot of classes for state societies of CPAs all over the country. So they'll have us come in and we'll do a seminar, either 2 hours or 4 hours, or sometimes we've done them for 8 hours. And the CPAs get continuing ed for this. And if the CPA identifies they've got a heavy clientele that is real estate strong, a lot of real estate investors, then they'll go to these events and or they'll read articles that we publish in the CPA publications or in the real estate journal. Like we're in New England Real Estate Journal frequently talking about cost segregation and what the new tax law is doing and this and that. So if the CPA recognizes that they have a client with a lot of real estate, typically they're attuned to what we do. Yeah. On the other hand, if they're thinking of you, Christine, and they know Christine is, I know you're a real estate person, but let's say you were an attorney, and Christine, the attorney, is, Christine originally owned a 2-family. And then Christine moved out of that and continues to rent that, and then bought another 2-family or 3-family, and then a 5-family. And they've started down this path of being real estate investors. Yeah. Well, often what I see is that the accountant never triggers in the accountant's mind that Christine is really getting heavy in real estate and they should really start to look at opportunities for Christine. They don't look at it and it just kind of goes by the wayside and they just do everything in 39 or 27 and a half year and they never break anything out. So then it takes a situation where one of those real estate people is at some conference or they read an article and they call the accountant and the accountant goes, I don't know about that. You're not going to have any depreciation left if you take it all early or whatever other conversation might be. And then, it is what it is. So, but we do a lot of work and usually if I am able to talk to the CPA, because I've been doing this for 21 years myself, if I'm able to talk to the CPA, I can usually help them understand the impact of this for the client. Yeah.
Now, are your classes and stuff, are they only for CPAs? Like if a person, God forbid, does their own taxes or something, could they come to one of your seminars so that they could do this kind of thing?
Thinking about that. I've never had, it was funny. We had the first seminar we did was in 2002 and it was at the Natick Crown Plaza. And there was one person there. We had 85 CPAs show up plus or minus. And there was one person there who was the real estate investor guy. He was the main person and he was a big player, but he had read about it. So he came and he brought his CFO and his CPA and it worked out great. But basically we were drilling down into such depth. He eventually in the meeting stood up and said, he goes, this all sounds great. He goes, you're completely losing me here. He goes, I'm going to leave now. But he goes, I want my CPA and CFO to stay here and listen in. Yeah. And this sounds great. And we're going to be dealing with a lot of detail that most real estate people glaze over and go to sleep if we start talking with that much detail. But if they wanted to send their own CPA or if they wanted to come and listen in, or have a conversation with me, I could probably help them understand it a little bit more, without having to
bring it down to a certain level.
Yeah, exactly. Where it's good enough for the layperson to grasp and take advantage of.
Yeah, and I think it's clear. The way you explained it, I think that anybody who has already started real estate investing and has even remotely looked at any of the tax ramifications could understand what it is that you are offering. And so now it's just getting the word out to everybody, right?
Absolutely. And the good news is, even for the properties they've owned, the IRS allows you to go back in time. So even if you've owned a property for 5 or 7 or 10 or 12 years, you can step back in time and grab that depreciation without having to amend your tax return. Because to amend, you only can go back 3 years, but the IRS allows you to use what they call it Form 3115, which is the change in accounting method. So instead of doing straight line depreciation, you're changing the accounting method to accelerated, and you use that change form, and it's automatically accepted by the IRS, and you don't have to amend your tax return. And you grab then 3 or 5 or 7 years worth of depreciation, all in the current year. So that's a big pickup there. So that works out nicely.
Yeah, that'd be a nice little check.
Oh,
or whatever.
yeah.
You know.
Yeah. Usually it's not a check back,
but it's
usually,
just a huge reduction in your taxes.
Correct. It's you have it as a loss for this year, all that depreciation, and it reduces your current year income tax. And then anything that you can't use in the current year, you get to roll forward in the next year. So that works out nicely too.
Yes, very. Wow.
Yeah.
That's a good tip. Good thing to know.
Yeah, good thing to know.
Yeah, because all the people who are listening who are saying like, oh man, I wish I would have known this when I bought my building, they can now like go back and.
Exactly. Yeah. As a technical point, you can go back to 86 when the tax law changed, but usually you don't go back that far. Usually the benefit, because the accountants will tell you, this is what the accountants call a timing difference. In other words, I'm not giving you more depreciation. You're getting the same depreciation. It's just you're getting it sooner.
Right.
Well, the benefit of that, the timing benefit of that, is usually achieved in the first 10 years. You might go push it out to 12 years, but that's really kind of the window that is most frequently looked at for these. So we would typically get depreciation schedules, because that's all we really need for those existing buildings.
Yeah.
All we need is a copy of the depreciation schedule. And if we can get a copy of the depreciation schedule, then we can do a Google search on the building. Oh, look at that building. It's a 5-family in, Salem, New Hampshire, or wherever, Boston, Mass, or Brookline, or whatever. Yeah. And we can then break apart what we would think as an estimate. And we know, oh, look at that. The depreciation says they paid $480,000 for it in, 2017. Here's what that benefit would look like. Yeah. So, and they can know roughly what the tax benefit's going to be before they spend a nickel. So that works out.
And what's the impact when I'm assuming that when they sell it, if they sell it, 7 years in or something like that, that they're going to have perhaps a larger tax burden at that time, right? As far as, because they've depreciated more of the building. I mean, I'm obviously not an accountant.
Yeah. So you do have recapture come back into play. Yeah. And that will be in play whether you're doing straight line or accelerated. What would be different would be there would be more recapture with the cost seg. So you might have to give back some of that tax benefit, depending on when they're doing it and how the accountant is attributing values to everything. But a lot of clients in the real estate space, especially, they're going to do what they call a 1031.
1031 exchange.
So if they're doing 1031 anyway, which is deferring the gain, what would end up happening is they would do that 1031 when they sell, and the recapture never comes into play because you're deferring the gain and you're not having to deal with that. So the recapture conversation wouldn't pop up then.
Yeah, but it's obviously, I mean, you wouldn't do it on any kind of a short-term thing anyway. So, I mean, that's obviously correct. Your future plans for the building have to come into play when you're making the decision whether you want to go this route.
That's absolutely correct. So we would say to you, hey, Christine, if you're only planning on holding this building for a year or two because you're going to put paint on it and fix up the apartment units and sell it real quick, then this does not make sense to do. Yeah. Unless you're going to do a 1031, and then it would. Because if you're doing the 1031, the giving back of that tax benefit
doesn't happen.
Does not come into play.
Yeah.
So, 1031's on the table anytime, any amount of hold time is fine. But if you said, I hate 1031s for whatever reason, I'm not doing a 1031, then we would say, if you need to hold it for at least 3 to 4 years before it is going to make sense without a 1031.
Yeah. Yeah.
Now, keep in mind, if you've already owned the building for 3 or 4 years or 5 or 7 years, and you do a cost seg and you're not going to do a 1031, then it does make sense. So I'm talking about just the hold time, not the time you're going to hold it beyond having completed the cost seg.
Right.
So
well, because it's going back in time anyway. So
correct. Yeah.
Yeah.
You got it. That's it.
Yeah.
That's it.
Well, it's interesting. I mean, I think, I don't know why you wouldn't want to take advantage of it then. I mean, is there anybody who shouldn't, besides somebody who's thinking of selling in a couple of years? I mean, are there any scenarios in which it really just doesn't make sense for some particular type of investor or type of building or anything?
Where it wouldn't make sense is if there's a couple of times it wouldn't make sense. Like you said, if you recently bought it and you're not going to hold it for more than a couple years and you're not going to do a 1031, then that doesn't make sense to do.
Yeah.
Okay. So if you're going to buy, I'm going to say buy and flip, although it's not truly a flip.
Yeah.
In the way that most real estate people use the word flip. But if you're going to not hold it very long and 1031's not in play, then it doesn't make sense to do. If you're going to hold it longer, it is in play. If you don't have enough taxable income. In other words, so sometimes I'll be referred in by not a CPA to a client. And at the face value, it seems like this person would be a great candidate for cost seg. So let's say and I'm going to just use an example. They own this big building and they bought it in the last 5 or 10 years and they paid well over, $1 million, $2 million, $3 million, whatever the heck it is. It's a big number, whatever the big number is.
Yeah.
And it seems like there's lots of stuff in there that would be eligible to take advantage of this. Sounds good so far. But that company manufactures buggy whips. Okay. Okay. And they make the best buggy whips out there, but nobody's buying buggy whips anymore.
Yeah.
Okay. So they've got a great product and they've got a great facility and man, it looks like it should be great for cost seg, but they're not making any money. In other words, they're not paying any income tax.
Right.
Well, if they're not paying income tax, I'm not going to help them because my thing is reducing income taxes. If they're not paying income tax, in other words, they're losing money on their operation, this isn't going to help them.
Yeah.
So, and I'm trying to think. I think those are the 2 times you typically wouldn't end up doing them.
Well, because in your example of $1 million building, if you just took all your money and, for example, use the attorney example. The attorney says, I'm going to take some of my savings. I'm going to put it into real estate. So I'm going to buy this $1 million building. I'm going to put the $200,000 down. But the income from the building is probably just paying the mortgage at this point, and the attorney income isn't really high enough. So to save that $100,000, off to get that $100,000 in depreciation, you need to have $100,000 at least, right, in income.
Correct. Income, keeping in mind in the scenario you just gave me with the attorney, that's going to be passive income for them.
Yeah.
So they're getting passive income from their building that they bought.
Yeah.
And my losses are considered passive losses. So to use a passive loss, you have to have passive income.
So they couldn't even take that off their attorney money, the money they make.
Typically, no. Typically, no. Unless they're a real estate attorney and they're the people that can use it against ordinary income as opposed to passive income are real estate professionals. So if you are, quote unquote, a real estate professional and you sign your tax return just under your name where you do your signature, if it says real estate professional, you're good to go, and you can use my losses against ordinary income. Whereas if you are an attorney, for that matter,
Divorce attorney,
a divorce attorney, you're a real estate agent or broker, for that matter, if you're not, doing a lot with real estate transactions for your own holdings, you can't claim that. And there are some reasons that you might not want that designation. Usually I hear accountants won't put somebody into a real estate professional category because they're going to end up having to pay Social Security taxes on everything versus it not.
If they had an LLC or something.
Correct. So there are some reasons not to have that designation, but if they've gotten to the point where they can use Cost Seg and they meet the other requirements for that, then they probably would want to consider that designation on their tax return. So
does it matter? Talking about LLCs just reminded me, like, if I have all my units, all my buildings in individual LLCs, is that going to keep me from taking advantage of this? Because it's a separate legal entity. So if one of my buildings takes a nice loss, can I still apply that to the other buildings, even though they're separately held?
Okay, so just to clarify and be precise with my language. So the way that it would work is let's say you only chose, some of your buildings were only $100,000. You bought them a long time ago.
Yeah.
The market was different then, and you paid $100,000 each. So those don't make sense. But over time, you've moved upstream and you've ended up buying some $300,000 and $500,000 and $800,000 buildings. So now you've got a smattering, but the small ones you're not going to do. And just to test the water, you're only going to do the most recent purchase, and that one's $500,000, let's say. Okay. Yeah. So you create the loss for that $500,000 building. Okay. And that loss is going to flow through to your personal return from that LLC to your personal return.
Yeah.
So on that one, you've got a passive loss there. But on all those other buildings that you have, you've got passive income flowing into your personal return.
Okay.
So the good news is the loss we create on that $500,000 building can go to reduce income tax on the passive income you have from all your other buildings.
Okay, good.
So that's even if that $500,000 building, let's say you closed on it December 15th or December 29th of 19, you get to take all of the losses for the next 5, 7, and 15 years as a passive loss in 19. Okay. So you get to take all that depreciation, and let's say there was only a teeny bit of income that you
on that one building.
Yeah. One thought process might be, well, I don't even have it's not fully tenanted yet. So it's not really creating that much income for me. Why am I going to do this now? Well, you've got all those other buildings that you get to use those losses on if you want to reduce your income taxes in 19. Now you could say, I'm going to wait until 20. Okay, fine. You can do that too. So it's just up to you and how you want to do it, and your accountant usually.
Yeah. Okay, good. I like all these.
Yeah, it's great. And usually people say, why wouldn't I do this?
Yeah,
and
exactly.
Like I said, if it's properly explained, then people will usually say, and they have taxable income. So if it's properly explained and they have the taxable income, it is kind of a no-brainer.
Yeah.
Now, if I explained it to you like this, hey, Christine, this cost seg thing, you're going to get the same depreciation either way. This guy Hyatt's not giving you any more depreciation. You're just getting it a little bit sooner, and he's going to charge you to do it. Well, that's pretty negative. I mean, that doesn't sound very good. Logically, you would go, yeah, why would I want to do that?
Yeah.
But then, his CPA partner across the table, he goes, well, wait a minute, but with that money that you save that Hiatt is giving you better depreciation on now, Christine, you can go buy your next building sooner because you don't have to send money down to DC, and you get to redeploy that money sooner. Or, and the bankers don't like to hear this, or you could prepay your loan and save yourself 5% interest because you've got a loan.
Right.
Or you can go renovate the apartment building more quickly, because now you just freed up X dollars, and you can fix up units 2, 3, and 4 when you thought you were only going to be able to fix up unit number 1 this year. Well, now you can fix up the other ones as well, not having to borrow as much money.
Increase your rents, and
That's it.
Exactly.
Increase the rents, make the curb appeal of the building nicer, whatever it is. You've got a lot more flexibility with it, though.
Yeah. Money in the hand is always better.
Correct, but it does depend on how it's explained to you.
Yeah,
and I fully agree with you. I think that if you can take the deduction now, why would? And if I said to you, hey, Christine, would you rather take a deduction now or in 39 years? Most people would go, I'd rather take it now. I know, it's crazy, but that's kind of what. Or they say, oh, but you won't have any. And the knee jerk for the CPAs who are not as familiar with it, they say, well, why? You're not going to have any depreciation later. What are you going to do then, Christine? You're going to have all this phantom income, and you're going to have to be paying all these taxes, and you won't have any write-offs. You go, wait a minute, that's not the case. You're just taking some of it sooner. So,
yeah. Well, and also, I don't know. That's just kind of who cares? It's like 39 years from now. I mean, let my heirs worry about it.
Exactly. A good number of us are going to be croaked by then. So,
Right.
And by the way, on that note, since you bring up that, upon death, so if generation 1 does this, then generation 1 passes on, the properties hand over to generation 2, the depreciation clock resets. So there is no recapture at that point. Generation 1 has used the cost seg to grab the tax deferral now, and then when they croak, the clock resets and generation 2 can grab the depreciation then. So that's kind of a big win, except somebody had to die. So somebody's not too
But that was going to happen anyway.
Hey, that's what I'm saying.
So, but I mean, that's another part of the decision-making process, right? I mean, if you think, well, by time 30, so 20 years from now, I'm whatever age. I mean, so I'm 56. I mean, I'm thinking I'm going to still be around in 40 years, but that might not end up being the case, right? And then, so it should be part of my decision-making process that, while I'm still young enough to invest in more properties and have more, things going on, that I should get all the money I can in my hand. And, later on.
That's part of the deal. Yeah. Part of what you got to think.
Generation worry about it,
Yeah. But again, it's not, if that's the scenario, is you're just saying, hey, it's going to the next generation. It's nothing for them to worry about. As a matter of fact, they would likely say, hey, Christine, you should hurry up and do this.
Yeah.
Before you croak.
Right.
You get the tax benefit now, and then when you croak, it resets. So that is a big deal. But,
yeah, it is a big deal. I'm glad we kind of accidentally got into that.
Yeah.
Any other things like that you can think of, like any other huge gains for doing this that maybe we wouldn't have thought of?
Well, one of the things that just happened about 2 or 3 weeks ago now, Congress fixed one thing that had expired, and they did it retroactively for 2 years, so that what had expired was a deduction and or credit that is in place for people who make their buildings more energy efficient.
Yeah.
So if they do energy efficiency upgrades, so if they do lighting and HVAC and building insulation, they can get $1.80 per square foot as a tax deduction. That was reapproved. It had been in place since the Energy Policy Act of 2005. and it expired 12/31 of 17. So now it was just reenacted December 20th of 19, retroactively to 17.
Yeah.
And it's going forward to the end of 2020. So now there's a little bit of window for planning, but at least they've got $1.80 per square foot as a tax deduction. If they do energy efficiency upgrades to apartment units, it's not that $1.80 per square foot. It's a $2,000 per housing unit, in other words, per apartment, tax credit. So if they had 5 units, it would be potentially a $10,000 tax credit, which is a dollar for dollar offset versus the $1.80 per square foot deduction, which is a deduction against income. The tax credit is an offset.
Nice.
So that got reenacted. That's a real nice one there.
Nice.
Yeah.
Excellent.
So these are all the areas that I swim in, all the swimming pools I swim in. You know,
like, well, any legal way that I can pay less taxes, I'm happy to hear about it.
Exactly. Yeah. That's a good thing.
I don't want to be, being chased by the IRS, but if they're just like, oh, okay, well, everything you did is cool, then I'm very happy.
Yeah. And it's all legal. It's all in the tax code. I could get a lot more. I could, bore you to tears pretty quickly with some of the tax details, but the big picture is what we've covered here. So without getting too far into the weeds with everything.
Well, it's funny. That's one thing that I've noticed is when you talk to a really good tax accountant or somebody who does, tax related things, the really good ones are excited about all the ways that they're saving you money. Whereas like a bad one is like afraid that you're going to get audited. He's like, no, come on, bring it on. We want it,
Well, and like you say, if it's legal and it's not going to create a problem, why would you not want to take advantage of it?
Yeah, so, exactly.
Yeah.
Exactly.
Well, I'm glad we've gotten able to talk here. So did you have another question or two?
Well, yeah, I just wanted to quickly say, do you have like a blog or a website where, people wanted to get more information and stuff? How would they reach you? How would they learn about you?
Well, yes, the website, I've got a couple of different ones. The one that's really, really specific to cost segregation is costsegstudies.com, which is costsegstudies.com. The other one that's a little bit more wide-reaching is revenuebanking.com, which is what my original domain was back in 94, and I've just added tools, and it's become more focused on cost segregation, but there are some other tools that I mention in there on revenuebanking.com. So there's a couple different options to get to me, but I don't do a blog per se, and I'm not a social media guru or person. This is high tech for me, this podcast.
Yeah, so. Well, it's good. I'm glad you got your camera going. This is.
I know. I was like, hey.
Yeah, so I'm going to put links to all your stuff on the website for the podcast, getyourfillpodcast.com, and I'll also, I'll also ask you for a picture, and I'll put a link to the video if people want to watch the video and all that. So there'll be a transcript, and from the transcript, I'm going to create a blog, which I'll send to you to approve if you don't mind.
Not at all. That's cool.
Awesome. Awesome, because I'm becoming a social media guru.
Good for you. All right, that's great.
And then, so is there anything else I should have asked you? Anything I forgot to mention, or that is exciting that in your realm that you want to share?
Not so much. I mean, you've covered them all. One of the big things is you can go back retroactively, so that's a good thing. That's a big, exciting thing. The new tax laws really have enhanced the benefit. And, it's viable for anybody that's got 500K or more in buildings, and that's where we work. We do big buildings. So we've done 32-story office buildings in downtown Boston, and we do little quick service restaurants that serve coffee and donuts, so we do all kinds of different stuff, but apartments are one piece of that.
Well, and you had mentioned also if someone's renting, but they do a lot of capital improvements to the unit, like in the case of a restaurant, I kind of glossed over that, but do you want to just quickly address that? It's just the same process.
Same process. Here's the crazy thing. The new Tax Cuts and Jobs Act, it used to be prior to TCJA that restaurants had their own 15-year depreciable life for everything. So it could even be that their buildings, their overall buildings, which everybody else had 39-year, it could have been prior to TCJA that they would get 15-year on the building and 15-year on their improvements.
Wow.
Well, that went away under TCJA, and they fell back to the way it used to be, which is 39-year for their building, and they got 5, 7, and 15, just like everybody else for the other stuff. So restaurants, we had a restaurant chain that was told by their accounting firm that we've done everything we can, we've taken all the acceleration we can, and you're all set. Why are you talking to Hiatt and his guys? And we ended up saving that client we got them about $2 million of additional depreciation that their accounting firm had been throwing them in to the wrong depreciable lives. And we were able to help them go back, save them a bunch of dough. And at one of their conferences, one of the big franchisees was walking around with a photo of of the savings we had made for him. So he was a very happy person. Very happy.
That's the kind of advertising you want.
Yeah. What do they call it? Raving fans or something?
Yeah,
something.
Absolutely.
Yeah. So it was good. That was nice.
Excellent.
So,
Excellent.
yeah.
Well, thank you very much. I appreciate it. I feel much more educated now
Well,
about
good
this
deal.
whole
Well,
domain.
I'm glad we could do this. Yeah. Even though it's a little snowy and junky outside, it was good to get this connection and make it happen. So thank you for calling in and making me jump into the
20th
podcast.
century.
Yeah, exactly. Yeah.
Well,
I've
who
got a
knows?
great
Now maybe you
backstory.
want to do your own podcast.
Maybe someday. I'll interview you for that one.
Sounds good. Thanks, Jeff.
All right. Okay. I'll talk to you later. Thank
All right.
you.
Take care.
We'll
Bye.
see you. Bye.